Consumer confidence just plunged again deep into recession territory. At the same time, services industries, they're reporting plummeting results and especially expectations. The Philly Fed's measure fell to its lowest level since 2020. Similar results in New York, Chicago, even Richmond. Recession forecasts are going up all over Wall Street and its banks. Consumers are worried about jobs and incomes. They're right back to where they were last autumn. And I've been pointing out ever since then how the pickup last year was not real. It was at best hollow and proved to be transitory. The high was based on emotion and artificial activity, so it was doomed to quickly roll over. And that's exactly what the data keeps showing, as we'll see here. The same pattern is everywhere. A boost around October, peaking in December, then rolling down in January before reaching what is looking like a cliff February into March. That's what these services numbers are really picking up. If it was one place, maybe two regions, you might overlook them. But we've gotten 4 of them in the past few days, 2 of them today, and they all show the same thing. Massive loss of momentum, services momentum. At the very least, it appears to have nosedived. And that's from an economy that wasn't performing well to begin with. This downturn wave has become so overwhelming, we're even seeing mainstream economists and other commentators, the last people who were going to be thinking about the R word, they're all upping their forecasts. And I don't mean growth. We're talking about contraction chances here. The forgot how to grow economy didn't suddenly remember late last year. Instead, we're being reminded of that fact. More people are being reminded of that fact as we see the sharp loss of momentum show up in more and more places. Most important of all, with consumers and sentiment. And consumer sentiment it's not necessarily about spending as it is a reflection of job market perceptions, income perceptions. Those are the 2 factors that keep coming up time and time again as consumer confidence continues to plunge. The latest one was from the Conference Board. The Conference Board reported today that its expectations index, based on consumer short-term outlook for income, business, and labor market conditions, dropped 9.6 points to 65.2. That's the lowest level in 12 years. And well below the threshold of 80 that usually signals a recession ahead. With the expectations index falling that far, the overall index made a substantial decline as well. Consumers are increasingly afraid of jobs and incomes. And where prices come in, it's not over inflation. It's about the fact that anything that raises prices, given the situation of jobs and incomes, consumers know, having already been left far behind already for the last couple of years, they're going to be left even more behind with no opportunity to make it up. It's a toxic mix. It's a bad mix. It's a massive loss of momentum. And there's more. Back to the Conference Board. Consumers' expectations were especially gloomy, with pessimism about future business conditions deepening and confidence about future employment prospects also falling to a 12-year low, which means we're talking about the same territory as the early to middle part of the 2010s, which is the last economic climate and period you ever want to be compared to. Meanwhile, consumers' optimism about future income, which had held up quite strongly in the past months, largely vanished, suggesting worries about the economy and labor market have started to spread into consumers' assessment of their personal situations. They're beginning to realize that, as I said in the introduction here, and as I've said repeatedly for the last 6 months, last year was an artificial high. It sounded good. You got the Fed doing rate cuts. You got a change in the presidential administration, Congress, and everywhere else. You got artificial activity, even if it was boosted by front-loading stuff before beating tariffs. You had a bunch of stuff that made it look like things were moving in the right direction. But you could tell that it was hollow at best, and it was doomed to be transitory. And now we're on the other side of it. We can see that more and more clearly. Even the labor market numbers, which had dropped sharply in the month of February for the Conference Board, they were basically unchanged here in March. So you put all of these things together and suddenly consumers are saying, we don't like the situation where it is, nor do we like where everything seems to be going. With jobs and incomes being insufficient to begin with, going back to last summer, Nothing really changed in between. You had a couple of temporary months that were boosted by this artificial stuff, and that was it. Get to 2025, and that's what we're getting all over the place. Rolling back over, sharp loss of momentum. Suddenly people are talking about the R word in a serious way, maybe more serious than back in 22 and early 23. Maybe the most serious since 2020. That's what some of these numbers keep looking like. I mean, consumer confidence and expectations, job fears, the lowest for the Conference Board in 12 years. That's something that we really need to pay attention to. It's what consumers are telling us about their perceptions in labor. But this loss of momentum, as they keep saying, is widespread. And it's gotten to be more obvious and evident in the services industries, which is the last place you want it to be. So we've seen services start to roll over the last couple of months too, but here in March, some of these stats they're starting to be really eye-opening. I talked yesterday about how S&P Global's PMI for the services industry actually picked up in the month of March, but how it was very likely to be nothing more than high-frequency noise, just month-to-month fluctuations, that there was no corroborating evidence for an actual pickup in services. Well, the Federal Reserve's data on the services industries in the various Fed regions shows that was actually the right interpretation. That whatever happened with S&P Global was likely a temporary fluctuation at best if it wasn't statistical noise. And that by and large, the rest of the services data is increasingly ugly, very ugly. This massive loss of momentum, starting with Philadelphia and the Philadelphia region. The Philadelphia branch of the Federal Reserve reported for its PMI on services minus 32.5 in March from minus 13.1 in February. If you've been following the Philly Fed Services PMI, and there's no reason why you shouldn't, it had been plus 6 back in October. So from plus 6 in October, that artificial high, and started to roll over as soon as November and December. By the time you get to March of 2025, you're going from plus 6 to minus 32.5, and minus 32.5 is the lowest since 2020. New orders plunged, had been plus 1.6 in January, minus 1.3, now minus 19.5. Full-time employment, minus 7.5, which is the first negative since last August. And it gets even worse from there. When the Philly Fed surveyed its commercial respondents, it asked them what they thought the business conditions were for services industry in the Philadelphia region. That index fell to minus 24 in March from minus 1.1 in February. Sharp loss of momentum. And even the firm response, do you think conditions for your firm will be better 6 months from now compared to where it is today? That one went to minus 19.8 from 13.8 in February. And worst of all, that's the first negative reading on this particular data point since April of 2020. So services businesses in the Philadelphia region are net pessimistic for the first time since 2020. And it's not just net pessimistic, it's not just net negative in the index number. We're talking about minus 20, sharp loss of momentum, huge downgrade in optimism and expectations. Optimism has disappeared and been replaced by deep pessimism. And if it was just one region, okay, you could say that's not good, but it certainly doesn't represent everything else. And so maybe Philadelphia is struggling, but the rest of the economy, the rest of the services industries around the United States are performing relatively well. But that's not the case either. S&P Global being this lone outlier. Other Federal Reserve regions have come in with similar results, and shockingly similar results. The New York Fed, its PMI for services industries, that one dropped to minus 19.3 from minus 10.5 in February. And that one had been minus 0.5 back in November, so already starting to head lower, and plus 1.8 last August. The expectations index, minus 3.3 from plus 21.6 last month. So you're talking about a nearly 25-point drop in expectations in March alone. That's the first negative for the expectations index since April of 2023, and it's the biggest negative since December of 2022, the last time everyone was talking about traditional style recession. And that was the time when we inflected. The entire global economy went from the supply shock upside to the forgot how to grow downside. So we're into what looks like more and more evidence for the loss of momentum, which means an inflection, which is something I went over in yesterday's webinar here at Eurodollar University. There's a replay link in the description of this video. And in that webinar yesterday, not only do we go over some of these recession patterns, because there's more than just one, we went over some of the things that you can do about it. And I also offered a special limited time deal on Eurodollar University subscriptions, the deep dive analysis, the daily briefing, and the memberships that have you covered for all of these gaps that are left behind by traditional economics and certainly the financial media. So check out the webinar, check out the deal. There's a link in the description for both of those. But from the New York Fed, it says that business activity declined significantly in the region's service sector in March, according to firms responding to the Federal Reserve Bank of New York's Business Leaders Survey. The survey's headline business activity index fell 9 points to minus 19.3, as I said, but that's its lowest level in more than a year. And the business climate index fell 16 points to minus 51.7, its lowest level since 2021, suggesting the business climate was considerably worse than normal. That's putting it mildly. Looking ahead, firms turned pessimistic about the outlook, and the future employment index dropped to its lowest level since 2020. Sharp loss of momentum, huge shift in expectations, huge downshift in expectations, all the things that you associate with the traditional style recession, the forgot how to grow economy, remembering how to recession. From Philadelphia and New York, we go over to Chicago and another substantial drop in the services industry PMI. The non-manufacturing activity index prepared by the Chicago Fed, that one was minus 20.6 in the month of March from minus 12.4 in February. And back in December, it had been almost plus 9. Again, we keep seeing the same pattern over and over again. You had the downturn last summer that looked like the economy was heading into recession, and then a bunch of artificial stuff happened. Fed rate cuts, the election, the boost of the front loading of activity for tariffs, and it looked like the economy turned around and avoided the worst case. It had hit its soft landing. It was confirmed, except it wasn't. It was all temporary. It was all artificial. And this is, by the way, is not inconsistent with recession patterns to begin with. There are fits and starts, backs and forth, ebbs and flows. Even an economy that's heading to a recession will look like it's heading into a recession, then deviate at the last minute, and then fall further into it. Sharp loss of momentum. That's what we're seeing here. We got the artificial highs last year after the recession scare last summer, which means we're not only getting back to where we were last summer, as all this data is showing, the loss of momentum is even greater now than it had been in, say, July and August. And according to the Chicago Fed's survey of economic conditions, respondents' outlook for the U.S. economy for the next 12 months deteriorated, turning pessimistic on balance. 54% of respondents expected a decrease in economic activity over the next 12 months. The pace of current hiring increased, but respondents' expectations for the pace of hiring over the next 12 months also decreased. Both hiring indexes remained negative. And that's where consumer confidence is falling off so sharply. The perceptions about labor market conditions, fears over jobs and incomes. One other regional Fed survey, services PMI that came out today, the Richmond region. Their revenue index for services industry companies, that one fell to minus 4 from plus 11, and you'll be shocked to find out that it had been plus 23 back in December. So from minus 11 last August to plus 23 in December, and now back to minus 4 in March. The direction is clear, and it traces out the pattern that I keep talking about and referring to here. The demand index from Richmond, minus 6 in March from plus 13 in February, and that one had been plus 17 back in January. The same pattern in all of these regions, as well as all of the subcomponents and categories as well. So it's the economy that looked like it was picking up last year, soft landing confirmed, nope, rug pull out from under because it was all artificial. It was indeed transitory. And with this loss of momentum showing up in so many places, even Wall Street economists and commentators can't really dismiss it and ignore it anymore, not much as they would like to. The last thing that Wall Street economists ever want to talk about is the R word. They want everything to look good and soft and strong, soft landing, strong and resilient. Everything that Jay Powell says, they want to confirm it and then some. But they have been unable to do so. Starting with one of these proclaimed bond kings, Jeffrey Gundlach, who was on CNBC last Thursday. And according to the CNBC write-up of his appearance, The widely followed investor now sees a 50 to 60% chance of a recession in the coming quarters. Quote, I do think the chance of recession is higher than most people believe. I actually think it's higher than 50% coming in the next few quarters. And DoubleLine Capital CEO said Thursday there could be another painful period of volatility on the horizon as the fixed income guru sees heightened recession risk. And talking about volatility, they mean in the stock market. The stock market, as I keep pointing out, has been saying, the stock market hates only one thing, and that's the traditional recession. So the signs increasingly show the probability of a traditional recession goes up, which includes a sharp loss of momentum. Not good for the stock market. But he's not alone. It's not just the data that we've gone over today. Even Deutsche Bank said yesterday the chances that the U.S. is heading for a recession are close to 50-50, at least according to a Deutsche Bank survey that raises more questions about the direction of the U.S. economy. The probability of a downturn in growth over the next 12 months is about 43%, as set by the average view of 400 respondents during the period between March 17th and March 20th, which is last week. So according to last week in Deutsche Bank's survey, chances of recession, traditional style recession, going from forgot how to grow into the traditional style recession, are maybe up to as much as 50%. Gundlach says 50 to 60%. Deutsche Bank here says 43%, and they're not the only ones either. Even Barclays is noted, and Barclays trying to be as optimistic as possible. Barclays analysts noted that, quote, market-based measures are consistent with only a modest slowing in the economy, talking mostly about stocks, not really any other market-based signals, though the firm expects a growth rate this year of just 0.7%, barely above the recession threshold. And it's actually not above the recession threshold. This is something I talked about in my deep dive analysis and went over to a certain extent in the webinar, which again, you can still see. There's a replay link in the description of this video. But the actual recession threshold is much higher for a calendar year basis than you might think. In fact, GDP on a calendar year basis in the year 2009 was modestly positive. So the recession threshold is a lot higher than people think. And in fact, the Federal Reserve's own estimates, which came out last week at the FOMC meeting, are right there at that threshold already. Even the Fed is right into the danger zone. So we've got sharp loss of momentum, consumers fearing about jobs and incomes. And why are they fearing about jobs and incomes? Because businesses, first of all, their outlooks have gone completely the other direction. Pessimism have set in. Massive loss of momentum indicated by sentiment surveys, and it's starting to show up in hard data as well. The economy looks increasingly shaky because it was not in good shape to begin with, and we see more and more evidence the chances of accelerated downside have indeed gone up. The probability of the traditional style recession has indeed gone way up. Markets can sense it. Even Wall Street economists can sense it. We see the data. We see the corporate reports that talked about FedEx yesterday. It's coming in from all sides. The forgot how to grow economy didn't suddenly remember how to grow. It's starting to exhibit all the signs that we associate with the last stage in what is still the same cycle. And that cycle, if it does complete, also threatens something like Bitcoin, especially the most leveraged player in Bitcoin, which I went over in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.